Good evening, everyone. Thank you for joining us today. Special thanks to the founders from Southeast Asia who are staying up late for this. A very, very warm welcome to the first edition of the Brick by Brick series, where we talk to the brightest minds from across the world on best practices in building insurgent brands. We're super excited about our first ever talk series that we're sharing with the broader consumer ecosystem. The title should be intuitive for the DSG founders. However, I think for the larger audience, I should clarify the reason why we chose Brick by Brick as the title for our talk series. This goes back to the origins of DSG. We were founded in 2012 and pioneered early stage consumer investing because we felt consumer brands required a different philosophy and business building approach when compared to tech businesses. In a nutshell, our belief is that enduring brands are built brick by brick with a strong focus on fundamentals, and hence the name. This is a talk series that's tailor-made for consumer founders. The topic for the first edition is lessons learned from over 15 years of growth stage investing in consumer brands. We have with us Wayne Wu, General Partner at VMG Partners, joining in from SF. VMG Partners is a leading consumer brand focused private equity fund founded in 2005. They manage assets over $2 billion US. The firm invested in a number of iconic brands, including Justin's Nut Butter, Kind Nutrition, Quest Nutrition, Drunk Elephant, Lily Sweets, and many, many more. The firm also has an amazing track record of exits, and Wayne has been with the firm since the very beginning and has seen it all. Wayne, thrilled to have you with us in the first edition, and thank you so much for doing this early morning.
Thanks for having me. That was very kind. I hope I live up to everything you just said.
No, you absolutely would. And audience, throughout the conversation, if you have any questions, please post them in the Q&A window. I've allocated 15 minutes for Q&A towards the end of the conversation. So welcome again, Wayne. And for the benefit of the founders, would be good if you could give a quick introduction on VMG and how the firm came to be.
Sure. I technically have not been there since the beginning. I was really close. I was the second team member to join after the founding. So I joined January 2008. Our final close of our first fund at VMG was in summer of 2007.
All right.
And so we haven't really changed much since the beginning. Our focus has been to help build iconic brands and great business models. So our first fund was a $325 million fund back in that 2007, 2008 range. We invest in branded food and beverage, personal care, beauty, the wellness supplement space, and fitness. Where we've evolved over time is now we're investing on two different funds. We have our VMG Catalyst Fund, which is where we just raised our second fund, which is a $400 million vehicle to invest in the tech stack that powers consumer brands. So think about the tech infrastructure related to consumer retail. And then our core growth fund is an $850 million vehicle where we're investing out of our fifth fund now, still focused in the same areas in the branded CPG categories I've mentioned, as well as some multi-unit within those respective categories. And we're evaluating in early days potential supply and contract manufacturing in those core categories. So if you think about how we're thinking about the future, you have brands as the core, and then both the tech infrastructure, but also the physical infrastructure that powers these brands.
Got it. So, I think a good place to start this conversation would be on the investment decision-making framework at VMG. We have a lot of founders on this call who raised their seed and Series A funding. So if you could walk us through, at a very high level on the investment evaluation framework, the key aspects that you evaluate and perhaps some high priority metrics you look at as well.
We try not to overcomplicate it. At the root of it, we're trying to evaluate if there's real consumer demand for the product. And there's a lot of noise that comes to that process. A lot of times, I think both investors and entrepreneurs are just seeking growth for growth's sake, meaning it's all just about revenue growth at any cost and all revenue being created equal. And we really don't look at it that way. Whether the business is direct to consumer oriented or some blend of omni-channel through brick and mortar retail, we want to look. We're really focused on repeat purchase and relative performance to its respective category. So it's all about velocities and repeat. So right. Certainly when we look at a business and someone shares their financials that are generally, their own shipment data, that's all fine and good that it's growing. But we really want to unpack the direct to consumer and omni-channel metrics to really understand the economics of each transaction, as well as the velocities and repeat of purchase. So that's kind of one bucket. So if we don't have that first bucket, then we're generally not interested. That's the first important part of it, is understanding the economics, velocities, and repeat. If those are exciting to us, then we want to further dig into the economics and supply chain. So understanding gross margin, contribution margin, and what the supply chain looks like in terms of either their own vertical integration of manufacturing or what the contract manufacturing landscape looks like for that particular product. If that is scalable and scalable from that dynamic, then it's interesting. And also on the first point, we want to look at the TAM. So are there, what are the relative velocities, economics, and repeat look like? And what is the overall market landscape? Because with a lot of new age categories, defining TAM is an art, not a science. And what is the real TAM? Because a lot of times we'll get investment pitch books that define TAM in some massive way. And that's really not necessarily it's not really the market that company may be playing in. And so it's really defining what does the TAM look like to be able to build a scale business under our investment period, but also leave enough remaining TAM for the next owner of the business where they're excited about it too. So again, you have TAM, you have velocities, repeat economics, you have gross margin, supply chain, and then you have founder fit and alignment. So, with founders and the team, do we have an aligned vision as to what we're building? Because it's hard enough to build an entrepreneurial brand and company, but if you don't see eye to eye as to what the finish line looks like, it can be a real challenge. So this is definitely not in the order of importance. At the end of the day, we're not going to partner with anybody unless we feel like there's aligned vision of what we're building, and as importantly, aligned vision in terms of what the values are, in terms of who we all are as people, who we are as human beings, and how do we make positive impact in the world.
Got it. No, that's really interesting. And, especially your comment on just not absolute velocity metrics, etc., but you're always looking at velocity versus category benchmarks or even competition. One aspect that you didn't mention, but perhaps, you look at it, it is covered in what you mentioned is on the brand itself. So, how important is the strength of the brand in your investment decision making process, and how do you also assess the defensibility of a brand, of a business that you're evaluating?
That's a great question. A lot of times it's a combination of different metrics. I personally find there's nothing stronger than still consumers voting with their wallets. So I still go back to the economics, relative velocities to category, and repeat purchase. We'll often add on other there's still quantitative metrics, but not financial. So, net promoter score, satisfaction, propensity to recommend, social media metrics in terms of followers, engagement, things of that nature. So those are nice to have metrics that help support the core of, the right economics, relative velocities, and repeat.
Right.
Because at the end of the day, and it's also time, do they show strength in those metrics over a period of time? There's a lot of brands that do really well for a short period of time, call it, 12, 24 months. But if they're able to keep up the strength of those metrics I described, it really shows the strength of a brand.
Got it. Yeah. The endurance matters a bit, matters a lot as well. Completely agree. And, we spoke about the defensibility, of a brand and how you think about it. But when, again, just coming back to how you assess defensibilities from a business standpoint at the stage, you're evaluating a company, etc. Have you observed any patterns in your successful investments in terms of, specific capabilities that help them build long-term defensibilities?
There's nothing stronger than building a great brand, and where they've proven that they don't need to discount to sell the product. So
Right.
a good metric is just understanding how strong are the velocities, the velocities and repeat at reg price.
Mm-hmm.
So consumers are not, where they're not buying it based on value or price. In doing that over a period of time, that's really important. We haven't put much into patents or things of that nature because at the end of the day, for a lot of the type of categories we play in, people can work around patents and they're very expensive to achieve. So we're much more focused on brand and trademark ownership than we are about patents. Sometimes there is a supply chain advantage that's defensible. So if the product is unique enough where that vertical integration or unique third-party contract manufacturing regime creates defensibility, that's usually just a head start. If there's enough of a TAM and market size, that supply chain advantage usually normalizes over a period of time as other people build supply chain capabilities, but it gives you that head start to invest and build that brand. So all roads lead back to building a strong brand in terms of defensibility in the type of categories and products that we invest in.
Got it. And, switching to business fundamentals, you did touch upon a few metrics like, the store velocity, etc. But what are the top, and you also mentioned about gross margin. What would be your, go-to top 2-3 metrics that you use to assess business health?
I mean, gross margin's obviously one of them. I think we've universally struggled when we've had gross margins under 30%. So 30% fully loaded gross margins, if it's above 30%, it doesn't mean it's great. But if it's below 30%, it's almost assuredly bad. And we found that to be, something we've learned over time. There's no magic to velocity, units per store per week, dollars per store per week. That's a really important metric, but it's important in a relative sense. Comparing a beverage to a snack item on velocities is not a meaningful data point. So it's important in diligence and also as an entrepreneur to obtain the data to get a feel for what are your relative velocities compared to your peer set. And then that's the same on direct to consumer, comparing, LTV to CAC and your ROAS, profitability on first purchase. All of those metrics are hard to compare cross category. It's really around category to category, but more and more profitability on first purchase is really important. Justifying spend on LTV is really a difficult proposition. We've never been a real believer in justification CAC based on LTV. We really want to understand what the first purchase economics look like.
Okay. Irrespective of how frequent the purchases are, your preference is to ensure that the business makes money on the first transaction itself.
Not, if it doesn't make money, we want to understand how far from it. So it's art, not science. We're not ones to believe in a long-term LTV justification of the spend, so we don't want to see 2-year payback or something like that, and the gross margin as it relates to LTV and CAC are obviously really important metrics too. Where we struggle is sometimes the highest repeat purchase categories sometimes have the lowest gross margins. Therefore, the near-term payback is really poor. And then the only thing you can hang your hat on is LTV because the gross margins are low. So it's hard to drive anywhere near profitability on first purchase. So you have to justify a frequent repeat purchase over a period of time. But then a lot of times the companies don't have enough operating history to really validate what LTV really looks like because they maybe have their oldest cohort, maybe, still a year old or 2 years max. And that's really hard to, if there's a 1 to 2 year payback on LTV and the total operating history of the company is 1 to 2 years, and the gross margins are low, but theoretical repeat purchase is high. it's hard to make all of that. It's too much storytelling for us,
Got it. So for such businesses that don't have a long enough history, what are sort of the ideal targets that you think founders should have in terms of payback period or LTV to CAC?
It depends on a category.
Oh,
That's not an exact science.
right.
My biggest point of feedback is I think it's really tough for obvious reasons. I believe entrepreneurs should have more control of their own destiny. If they're creating a business that relies on a lot of theoretical long-term payback metrics, they're going to be at the mercy of the capital raising market. And for obvious math, the sooner that they can build real profitability, the sooner they have more control over their destiny, where they don't have to just stay on the fundraising hamster wheel and be able to have control of if and when they want to raise strategic capital versus have to raise capital because they built a business model that has a real finite lifespan to it unless they raise more capital.
Got it. No, completely aligned and resonate with that very deeply. That's a good segue into, the next section of the conversation where I'd like to spend some time on your views on, how consumer brands can achieve profitability, etc. I think the first one is I've heard you, talk about this in some of your interviews where you talk about the correlation that you've seen between profitability of businesses and the size of outcomes that you've seen at VMG. So could you, shed some light on that, on what you mean by that?
Absolutely. It's interesting. I think too many investors and entrepreneurs start companies based on press releases. And what I mean by that is, and I think it makes sense because they don't have any other purview. So they see a company like Justin's acquired by Hormel. The only metrics they can find are some type of reported revenue number and an acquisition value. And then people extrapolate a revenue multiple and assume that, well, that company must have been purchased on a revenue multiple. I think capital raising in the early stages has some form of revenue multiple because oftentimes the companies are not profitable. So you have to value it on something. But when it comes to actual acquisition by a strategic acquirer, which has been our primary focus over the history of VMG, is building brands for strategic acquisition, sometimes IPO, but our primary underwriting methodology is towards a strategic acquirer, one of the global CPGs. I generally find that the revenue multiple is really just a function of math. And the real driver is some type of projected discounted cash flow and EBITDA multiple. And so in order to maximize value, it's really the triangulation of growth and profitability. So even if you look at the US public markets today, in terms of the consumer growth IPOs, the best performing IPOs are more like the 10 and 10. So they have at least 10% growth and at least 10% EBITDA margin. And it's not the ones with 50% growth losing money or break even. And I find it to be the same way in terms of maximizing value for strategic acquisition is, think about it like 15 and 15 at a mature state, growing more than 15% on the top line and a 15% EBITDA margin. And usually that strong 15% EBITDA margin translates to strong gross margins. Strong gross margins are different things for different categories, but usually it's somewhere over 40%. And in some categories over 50%, gross margins. And when you're able to achieve that 15 and 15, and sometimes hopefully that's like 30% growth plus and 15% EBITDA margins, then you get that 20, sometimes you can get 20 times plus as an EBITDA multiple on that, from a strategic acquirer. And it leads to a large revenue multiple, based on the math. But then a lot of times it's still reported on the press release as a revenue, here's the acquisition multiple. And then it's some dated sales number, of the last full year reported period. And people extrapolate a revenue multiple from that. So the upshot again is nail both top and bottom line in an effort to maximize value. And you control your own destiny again to not get stuck on the capital raising hamster wheel. And we find that entrepreneurs and management teams that are capital efficient along the way are generally the best management teams. They know their business better than businesses that were just focused on growing top line for top line's sake and are stuck on the capital raising hamster wheel. They generally don't know their businesses as well.
Right. No, that's really well said, and it's it's quite enlightening that you're saying that most of the CPG strategics also look at, or rather, the primary multiple that they apply when valuing businesses is EBITDA multiple as opposed to just revenue multiple. It was something that I wanted to ask you as well, given your track record of multiple exits. So you mentioned clearly revenue growth is a major driver, and the EBITDA margins are a major driver in terms of just value creation. Are there any other aspects that strategics really pay top dollars or pay a premium for with respect to a brand or a business?
Well, scale is important. So the scale point for strategic acquisition has moved up. I find that, the market kind of ebbs and flows, but, you see very little strategic interest for brands with less than 75 million of US dollar revenue. Like there needs to be a real scale point. The other dynamic is it's not that you should sacrifice growth for profit. Growth is almost like table stakes.
Right.
So you need growth in order for interest from strategics.
Right.
But growth's not good enough. You need that growth combined with strong profitability. But you can't just have strong profitability and no growth. Like that doesn't work either. Yeah. Like growth is a checkbox in order to have any interest. Then to get it across the finish line, you need to have strong profitability metrics too. And then that growth needs to be unpacked with that growth needs to go back to the same metrics we talked about before, which are related to strong velocities relative to category, strong repeat, strong brand metrics. You got to have it all to be acquired by a strategic. And that's, I think that's where, I see so many investment decks of like, hey, we're going to get acquired by a strategic. There's really only so many brands that have been acquired by strategics, relative to how many brands are started, how many brands investors invest in. You have to essentially create a perfect business. You have to nail growth, profitability, regulatory compliance, legal, supply chain, trademarks, team, large TAM, like got to nail it all. And that's where we're focused with our brands that we invest in is, hey, revenue growth is great, but we got to nail it all. And we work together on working backwards from the experience we've had over the years, starting day one, actually starting before we even close on our investment. Because again, alignment's really important. We align on what are we building? And then we hit the ground running on really working through the front and back end metrics of trying to build a business that gives us the highest probability of strategic interest and building the best team we can in the industry to be able to hit those strategic goals in that in the various front end and back end dynamics that can give us the highest probability to have that strategic buyer interest downstream.
Got it. No, that's very, very useful. And, we at DSG are big believers in controlling your destiny and, not being dependent on fundraisers to keep surviving. So, on that, wanted to ask you something. We always tell our founders that the simplest way to make money is by not losing money. It's sort of the inversion principle that Charlie Munger talks about a lot. So, just by avoiding ways to lose money, you can ensure that you are able to make money. So would like to understand in your experience, what are the common reasons why consumer brands struggle to achieve profitability?
Great question. Poor gross margins. The number one dynamics, well, we're just starting out. We're going to have great gross margins when we have scale. I found that 9 out of 10 times, again, this is not an exact science. This is my own personal estimation. 9 out of 10 times, that company will not achieve the gross margins they think they will through scale. The brands that have strong gross margins from the beginning stay having strong gross margins. And the ones that start business models with poor gross margins are stuck with them. Now, there are 1 to 2 out of 10 cases where that scale benefit truly occurs, but I find most of the time it does not. And it leads to chronic cash burn issues. So that's one. Okay. 2, it's the concept that almost over marketing. So not really giving the brand a chance to see if there's organic demand for it. So it's spending irrational amounts on marketing versus really, really tactical and strategic marketing drives consumption. So trying to be all things to all people. So for example, not focused on looking at ROAS and CAC to LTV and profitability on first purchase, really refining how that direct-to-consumer marketing would work, or focus on out-of-home buying billboards and all sorts of things, to try to drive launch. A lot of times the best brands don't have to do all that. And it creates a culture of spend when you launch that way. It's hard to get out of that routine of overspend on marketing. Then the other piece is built the misconception that a great team means a lot of people. A great team means hiring really talented player coaches. You need a small handful of people who really want to roll up their sleeves, who are strategic and tactical to build a great business. There's, companies that overbuild total headcount too early, leads to chronic cash burn, because building a lot of team means they generally end up spending on other things. So it's not just the cost of the people, but it's the cost of the various initiatives, where that focus, a focused player coach team with a focused marketing strategy combined with the right gross margins, generally lead to capital efficiency. And it's either going to work or it's not. If a company had to hire a ton of people, spend a ton on marketing, have to scale into strong gross margins later, it probably was never meant to be in the first place.
Got it. So it's gross margins, marketing strategy, and and ensuring that you don't go crazy hiring a really large team. If I were to
That's
right.
You need a great team, but sometimes people equate great team with quantity of team, and that's a very different thing.
Right. Got it. A related question is, on this whole growth versus profitability paradox. And, our founders always tell us that investors like VMG or DSG for that matter, seem to be rare in the ecosystem who speak about profitability, etc. And they just feel pressurized to show a certain growth to ensure that, they're seen as building exciting businesses. So it's a conversation that that we have with most of our founders. What would your guidance be in terms of how founders should think about the right pace at which they grow, and and also the scale at which they ought to become profitable? I understand it's in the US context, but just the principles that you think they should use to just pace the growth appropriately and get to profitability, that'll be useful for everyone to understand.
And it's a good caveat. Know that all of my commentary is related to kind of a US and Canadian perspective. This is, I am not, I am far from an expert on the Asian, the Asian markets as it relates to that point.
Right.
From a profit, it really depends on the category. There's not an absolute to it. Yeah. I've found historically that, there's been real correlation. When we've been able to invest in brands that have strong growth and they're already profitable by 15 million of US dollar revenue. So there's strong growth and they're profitable at that point. That's usually a very good signal, in terms of the business model that they've created, because usually that implies the gross margins are pretty strong. It also implies that the team, that they're driving strong growth at that level, that there's a real path. Yeah. So that'd probably be my rough rule of thumb is around 15 million-ish of revenue. We've seen strong correlation when you're seeing profitability or strong profitability from there at that point, that's correlated with, and then you're seeing strong growth at that. There's something to, strong growth and strong velocity metrics. That's usually some good signaling.
Got it. And, for the benefit of the audience, in our experience, this is again in the Indian context, in terms of pacing yourself, our view is, if you can drive to 100 crores, which is roughly 15 million, interestingly, the number you mentioned, in 5 to 6 years from incorporating the company, our belief is that's a great pace, from our portfolio and outside. So getting to that $15 million mark in 5 to 6 years is a good pace to grow at. And in terms of profitability, our view is similar. Ideally, you should be profitable in the $15 million mark, which is 100 crores in INR terms. But, if not by 200 crores. So, those are sort of internal benchmarks that we use at DSG, but that's very helpful way.
It's a rule of thumb. It's not to
Absolutely.
say we don't invest in brand.
Correct. Absolutely.
Everything I'm talking about, it's art, not science. And that's,
Yeah.
I think for us, it's the learnings of over the last 15 years helps
Right.
us kind of calibrate. I don't believe in absolutes of like, well, it's got to meet this metric or that metric, or we're not going to invest in it. It's all subjective and objective. And it's a combination of all those dynamics that lead to us making a decision on whether we partner or not.
No, absolutely. Couldn't agree more. I think a related dimension, when it comes to this growth versus profitability discussion is around capital efficiency. You did, reference that multiple times in the conversation. And I know it's your pet peeve as well, the tendency on the part of investors and founders to overcapitalize brands in pursuit of unrealistic growth sometimes. What would your advice be on how founders should think about the quantum of capital that they raise in a growth stage round?
Oh gosh. I mean, it depends on the company. I'll start with the why. I admire entrepreneurship. And what I struggle the most is seeing when a very successful business gets to the finish line and the founders own very little of it. And so much of that is defined on how much they're going to own of their business, in those first few years of starting that brand or company. And so that's why I really like to stress all these various metrics, because sometimes the decisions that are made in those first handful of years in terms of the business model created and the capital raised, even at high values, is massively dilutive to that founder or founding team. So as a result, I like to focus on thinking about how to create capital efficiency where it gets profitable sooner rather than later, so that they don't need to raise as much capital. How much it is, it really depends on the
Yes,
gross
more in
margins of
terms of how.
it's circular, right? Depends on the gross margins of the business. It
Mhm.
depends on the approach and what the contribution margins look like.
Right.
The on some of the D2C driven businesses where gross margin is seemingly high, but they're spending, 20-30% in marketing to get to that contribution margin. Even though gross margin is seemingly high, they still need to fund that growth engine. Sometimes you have primarily brick and mortar businesses in the US that have a small D2C, but they've really built themselves through Amazon and brick and mortar. They may be, and if they pair that with strong gross margins, they may raise little or no money to get to 15 plus million of revenue. And they own all of their businesses. And I love that. There's nothing that brings me more joy than seeing a business, 15, 20, 30 million of US revenue, and they haven't raised a dime. I really admire, and to say that that's not possible, I see it all the time, actually. It is quite possible. It's just a path of how they've chosen to structure their business and the dynamics within that respective category. Some categories, it's not possible based on the gross margins of that category, but there are many that you can. And it's certainly possible. It's not common, but it's possible.
Got it.
But that's a real signal to us. When we see a business that's grown, to 15, $30 million and it's profitable and they're out there raising capital. And I love it when they have the benefit of choice. They go, we may or may not take capital, but we really want a great partner. That's to us like the dream scenario. Because a lot of times those type of entrepreneurs will, they want VMG. They want VMG not because they need capital. They want VMG because they want a great partner. We want someone who wants a great partner. A lot of entrepreneurs will say that every time. But at the end of the day, they need something because of their business model. They just need capital. And they may have been diluted significantly. So they're looking at valuation as a primary metric, because I can respect that, because they're just trying to manage their dilution because they've raised a lot of capital. What I love is when entrepreneurs say, I don't even need capital. I just want to find the best partner. And those are great scenarios where we get really fired up to get involved to help support that journey.
Got it. That's super useful. And, just talking about quantum of capital, that founders should raise. Of late, a lot of our portfolio comprises digital first brands. And, the biggest use of funding is always in marketing, which is, towards Facebook and Google. And, as we speak, there are a lot of brands in the portfolio that are figuring out how to keep the customer acquisition cost in check as they scale. And the recent iOS update didn't help. So, would like to understand the best practices that you've seen in brands that have kept the customer acquisition cost in check as they scale and probably optimize over time. So, would be great to understand from you on that.
I wish there was a perfect answer to that.
Right.
I think we're still coming off an era where there were a lot of brands built on Facebook, and that's been largely a macro challenge for most D2C brands now, of trying to find other customer acquisition channels that are as efficient. So the upshot is, the brands that have continued to have really efficient customer acquisition are those that aren't just Facebook ad driven. So they may have other content that they create, where there's a compelling reason for a consumer to interact with their brand. They have a unique influencer strategy where it's some influencer affiliate program where, there's other means of driving brand awareness and trial through various influencers. People have interesting, compelling TikTok campaigns, hard to measure, but you're seeing some brands do really well with some compelling TikTok campaign, other video content. So it's really around, the sort of low-hanging fruit of targeted Facebook ads has largely come to an end. And direct-to-consumer brands have to be a lot more creative about developing compelling content strategies to drive efficient customer acquisition. And you're finding that more direct-to-consumer brands have to go omni-channel earlier or at all. A lot of direct-to-consumer brands that never considered going into brick and mortar are having to do so now, and to really diversify their acquisition channels, but also continue to grow their businesses efficiently. But we're continuing to see really creative folks. It's really interesting to see innovation in this area, because we had a whole era. It was really a targeted Facebook ad driven marketplace. And now you're seeing a lot more diversification in how people go at it. Some people have cracked the code on it, and I think it's a real testament to the strength of their brand and creativity. And there's some that haven't cracked the code, and they're having to figure it out.
Right. Got it. No, moreover, as you said, one of the reasons you mentioned brands find it challenging to become profitable is, not sort of overspending in marketing. And, and as you said, if people have tracked the unit economics and have paid attention to keeping the acquisition costs in check from day one, that itself should set them well for the future. The other part I wanted to ask you on was about entering the offline channel, but I heard you say that brands are diversifying into the offline channel early on to keep the acquisition costs in check.
And not necessarily early on, it's just at a point in time, because there's real benefit to leveraging that online digital marketing spend. It helps drive velocities in brick and mortar too. So it's sometimes a shame that investment spend on online and digital isn't leveraged in driving brick and mortar. So I think it's in the US, you have brick and mortar retailers who are interested in bringing in digital first brands into their stores. So it's a nice complementary marketplace in the US, where you have interest from the retailers in bringing in digital first brands, and you have digital first brands that are more interested in omni-channel. But it just kind of depends on the category and stage and all of that, on what's right for one company is not necessarily right for the other.
Got it. I see a few questions come up, but let me try and wrap up my questions before that. The last section, I'd like to focus on founders. As you said you didn't mention the investment criteria in any order, but I think that founders are your biggest criteria. What are the important traits that you will look for in founders while investing? And could you also talk through common traits that you've seen in your most successful founders?
First one is self-awareness. So great entrepreneurs, in my opinion, there's two things. It's almost like sometimes self-awareness kind of goes both ways. In some regards, you have to have an extraordinary self-belief, because it's hard to be an entrepreneur, and entrepreneurs have this vision to be able to see opportunity where oftentimes others don't. And to have that vision, you have to have innate self-belief. But also great founders have the ability to evolve and see that innate self-belief in creating that opportunity, have enough self-awareness to build strength around them of understanding their own strengths in areas of opportunities and building a great team around them to be able to help be experts in the areas where it's not that founder's strengths. And then you combine that with being a good human being and a tremendous work ethic. And if you have all of that dynamic of, that leads to generally a lot of great outcomes, because, that ability to evolve and bring great people around him or her, when you combine that with great work ethic and a strong value system of being a good human being, a lot of great things can happen.
Got it. And, in terms of common traps that you see founders fall into, common mistakes that founders make, areas where you find yourself repeatedly cautioning founders on, could you talk a bit on that as well?
In terms of business model or?
Yeah, it could be in terms of business models, important strategic decisions, again, more just learning from past mistakes made and, and trying to understand if there are like common mistakes.
I think the unrealistic optimism and not having sufficient paranoia. So I think it's the optimism that creates visionary opportunities, which makes entrepreneurs great. I think having a sufficient level of paranoia. So a couple things. One, always assuming that the next day is going to be better than the last one. So, at some point, de-risking the journey for themselves. After you build at a certain point, consider take some chips off the table so that they don't keep all of their equity only in the business and don't take care of their families. I think that's an important point of don't always assume the next day is always going to be better than the last one. Redundancy. So if I had a nickel for every time a single source supply business goes, oh, I have a great contract manufacturer, but that's their only source of supply. So really, supply is the bedrock of branded product businesses. So having redundancy in supply for the rainy day and know that unlikely things happen and to make sure that you always have product to sell to consumers. So seen so many times founders burned by single source supply. And then third, again, is just around self-awareness, not evolving the business team and how it's run based on different scaling points. Running a $100 million business the same way it was run with the same team, same methodologies as when it was 10, as an example. Like businesses require evolution. I think lastly is not understanding everything as an ecosystem. So not treating people properly. Sometimes I'll hear, we're different. We're a new age brand. We don't need to adhere to any of the retailer rules or how business is done with retailers. We're reinventing everything and we don't need to treat suppliers and retailers with the same level of respect that other companies in the past have. We can do it our way and they just need us. I think that sometimes that hubris and arrogance works for a while until it doesn't. And then that lack of partnership and relationship with investors, suppliers, vendors, retailers comes back to haunt that company because it didn't act in the spirit of partnership. So it comes back to being a great human being, thinking about a successful entrepreneurial journey as a series of great partnerships and relationships, and always looking at the eye of creating win-win situations for everybody throughout that journey, as opposed to a scorched earth zero-sum game.
No, those are wonderful observations. I love the fourth one especially, and the first one as well, which is very important. Let me just wrap up with one final question, and then, we can take the questions from the audience. I hope we are in the new normal and there aren't any more waves. So would like to understand if you've seen any perceptible lasting changes in consumer behavior when compared to pre-pandemic days.
I think we're still evolving. So it's interesting. I think there was a perception during the core lockdown periods of the pandemic that consumers, I think there was some extreme cases where people would believe, oh, well, e-com everything is going to be the future. And I think it's continued to prove as at least the US has opened up, is that it's truly an omni-channel environment. There was certainly acceleration in e-commerce engagement during the core parts of the pandemic. But consumers want to buy their products everywhere they are. And sometimes that's through their phones in e-com, and sometimes they still want to walk into a store. But having said that, all stores aren't created equal. So stores need to create a great consumer experience. And so we believe in an omni-channel world. And I think it's continued to prove it's an omni-channel world, but it's very competitive. So consumers, investors, entrepreneurs need to continue to deliver the best experience they can to consumers, both online and offline. And, I think in some ways things didn't change. It just made it things just got more competitive.
All right. Great. So let's jump to the Q&A. I'm taking the first one first. So this is from Vikram. The question is, how do you define fully loaded gross margin when you said that 30%?
I would just look at US GAAP. You can look at it online. It's gross sales minus various trade spend, promotional spend that people use, and returns in in the brick and mortar and online channels. You have net sales, then you minus subtract out the product costs, freight in. Some people put freight out and warehousing in there. Sometimes you don't, depending whether you're vertically integrated or not. And then you have gross margin. I think given how expensive freight is, it's very important I'm very keen on looking into what's the margin after all freight and warehousing, because a lot that can be a very meaningful part of the P&L, in today's day and age. So someone just quoting their product margin to me is not all that relevant. I want to know what the margin is after all freight and warehousing.
Got it.
And trade spend.
Great. I think the next question is not very clear, so I'm skipping that. Ankita's question is on what are the key principles of inorganic growth? How do you value businesses you want to acquire? And what risk exposure should be taken into consideration? I think her question is more on principles to use when a founder is thinking about inorganic roll up in terms of valuations, etc.
I'm not sure I understand the question.
Yeah, as I read it, even I'm not too sure. So let me jump to the next one. No problem.
And I'm not saying it's a bad question. I'm just saying I don't understand it.
I'm not very sure either. So in the interest of time, I'm just going to the next question, which is, what are some case studies in the US that Series A brands can look at to learn how to go omni-channel?
I think Quest was one. I was trying to name a brand that's not ours, because another pet peeve.
Perfectly fine. You have a lot
my pet peeve also is our investors that just promote their own brands all the time, and it's a pet peeve of mine that I don't like. Yeah. So, but I need to answer quickly. So, Quest was a brand that started online. They were actually they were one of the first brands to have a Facebook influencer strategy. There wasn't even a name for it yet then. It just happened to be consumers who organically posted before and after pictures of utilizing Quest and as a primary portion of what they ate. And they leveraged that consumer passion into, launching in specialty. So like GNC and Vitamin Shop in the US. And then that success parlayed into a massive launch with Walmart. Where we did, I think another point of advice here, where mistakes were made, there's the pricing wasn't done right. You have to build a pricing model out in advance of looking at what your pricing is direct to consumer, through distributors, through various different specialty, mass, and grocery channels. Everybody has an expectation of what their pricing should be in that channel relative to other channels. And if you don't get that pricing right from the get-go, that can be a massive omni-channel issue. So really think through, as you start a company early, build out that whole pricing model on wholesale and what the shelf price will be and what you discount it at or don't discount it at across various channels to make sure all of your economics work. Do that up front, because it's really hard to fix later if you haven't done it correctly.
Got it. I have a quick request. Do you mind if we go on for another 5 minutes? I just see a few more questions. Is that all right with you?
Yes, another 5 would work.
Thank you so much for that. The next question is from Siddhant. It says, brick and mortar stores take time to establish and generate ROI. Are investors willing to be patient at the cost of growth? Is capex to build brick and mortar stores okay for consumer brands? So I think his question is on whether investors are patient for brands to build out stores and generate ROI, and whether, as a fund, you're okay with brands funding the capex for these stores.
So a lot of the brands we focus on, they sell through third-party brick and mortar. So, in beauty, there are certainly cases where you're building out your own brick and mortar stores. But that's fewer and far between. Most of the categories we play in, the branded CPG brands are selling through a third party, whether it's a specialty channel, whether that's a Sephora in beauty or a Whole Foods market in food, and then they're going through other. So, but as it relates to four-wall economics, I think the four-wall economics need to work relatively quickly. If you're building out a store to sell your own products, like it's just like online, you can't bank on a long LTV chain. It's the same concept. It needs to economically work relatively quickly, or there should be real question of like, why did you build that store and not go through a third party retailer or stay online digital?
Got it. I think the next question we covered, it's on, what are brands doing differently beyond Facebook ads, and how can one differentiate, or is just spending on marketing the only way forward? I think we touched upon it, at the end of our conversation. The next one is on, this is interesting, your favorite D2C brand, who you feel did everything right.
My favorite D2C brand. Gosh, I don't know.
Or maybe you could say more than one.
I gotta name one of my own again. I think Daily Harvest is a really interesting brand in business, where if you asked me 10 years ago, if someone could build a multi-$100 million direct-to-consumer brand with a frozen supply chain, I would have never thought it would be possible. So to see what Rachel, the founder there, has built in a healthy, plant-based frozen foods platform, all direct to consumer, has been truly remarkable. And that, it comes with the fact that they have tremendously market leading retention. So we talked about that earlier, about how important retention is. Yeah. They really surprise and delight consumers, where once they try Daily Harvest and they stay, and that you're able to build a business of that scale with a frozen supply chain is truly remarkable. So I really admire what Daily Harvest has built as a result.
Got it. Okay.
I named our own brand again, which is my own pet peeve.
Yeah. We have more questions, but I'm just going to ask one final question and we wrap up. It's from Aman, which is, what are the 3 most important things a startup must do to ensure good customer experience?
Responsiveness. It's amazing how many brands fail because they don't solicit and take consumer feedback well. So create a system where you're soliciting, whether there's some type of incentive for a survey, make it very easy for consumers to share their feedback with you, and then take action, take care, spend the dollars to solve that problem for them, and then fix that problem for everybody else so it doesn't happen again. So that's one. Make purchasing very easy. Having to go from one landing page to another landing page to another, whether to fill in a bunch of fields, nobody wants to do that. So make purchasing easy, make consumer feedback easy, solve their problems quickly. And I think it's going to lead to great results if your product is truly great.
Got it. No, very, very insightful. And, I know we've overshot and, to the audience, we have more questions, but sincere apologies, we've run out of time. But Wayne, thank you again for joining us. This was a wonderful session and there are a lot of takeaways for us and for the founders, I'm sure. And, really appreciate you taking out the time. And thank you everyone for joining. I know it's really late in Southeast Asia. Really appreciate everyone joining this.
Thanks for having me. I really appreciate it.
Thank you.
Have a good night, everybody. I'm going to go start my day now.
Have a good day, Wayne.
Bye.
And see you all in the next episode of Brick by Brick. Thanks, everyone. Take care.